Good evening, Marshall Reddick investors, and welcome to tonight's presentation on investing real estate with your 401k and IRA. Now, this is a topic that many of you have asked for, and I know you're going to get a lot of value out of tonight's presentation. But before we get started, I'd like to take a moment and talk a little bit about different ways that Marshall Reddick Real Estate can help our investors with all things real estate related. First of all, unlike a traditional brokerage where agents help their clients buy and sell their primary residences, Marshall Reddick does that, of course. But we stand apart in that not only do we help our clients with primary purchases, we also help them invest in real estate across the country in our vetted markets. And most of our clients own multiple rental properties under their portfolio. We also have a second division, which is property management. Now, there's no point to owning a great investment property if you don't have great property management to oversee your investment. Marshall Reddick has boots on the ground management with 24/7 service in all of our vetted markets. We also have a private lending division. Now, what does that mean? So let's just say you want to invest in real estate, but you don't want to own the physical property. Well, you can be the bank instead. In other words, you can find one of our fully underwritten loans for anywhere from 3 months to 30 years, depending on the note. You can collect the mortgage payment and be the banker. This is now a great way to invest in real estate without actually owning the asset. And under our private financing umbrella, you can also be a borrower. Qualified borrowers, we qualify our borrowers based on property. And this is great if you want to do a fix and flip or investment transactions and don't want to go through the conventional lending process. Now, last but not least, we also have our Marshall Reddick Investment Fund. This fund is designed for investors to pull their resources together and own a portion of the notes on many different properties. This is a great vehicle for investors who don't want to take the time to pick and choose their own private mortgages to fund. Now, a little bit about myself before we get started with the main presentation. My name is Sherry, and I've been a licensed realtor with 20 plus years background in residential real estate. I've had 7 years of experience in real estate finance, and I have bought and sold dozens of investment properties encompassing 3 states. I've also done numerous fix and flip transactions on my own. Real estate has always been my passion. Purchased my first house when I was 20, and I truly enjoy helping my clients now navigate their investment journey with both primary and investment properties. This is a little map of where our physical boots on the ground offices are for Marshall Reddick. These are some of our vetted markets that we have our own people, our own staff helping our clients not only with purchasing their investment properties, but also managing their investment properties. Little bit about how we choose our markets and where to invest. We look at the job market. What is it like out there? Is there military, medical? Who are the employers? What are the industries? The rental demand. Are more people moving into the area or out of the area? Who are these people? The economic diversity, the housing affordability, the cost of purchase versus the rental value, strong education, and my number one, reliable property management. I think this is the number one key component to having a successful rental property. And let's talk about what you can expect from a consultation with Marshall Reddick. Now, one of the biggest things that sets Marshall Reddick apart from any other brokerage is that our consultation services are not only free, but they're very comprehensive. What does it look like for an investor? Well, we sit down with each and every investor by phone or in person. We go through all the necessary components to put together a plan tailored exactly for what your needs and goals are. We start with the very basics of goal setting, which is looking into what do you do? What are you looking to accomplish? How old are you? Do you plan on retiring? A lot of things that go into a great retirement plan. And then we look and reevaluate and evaluate all your options. Decide on your time frame. Are you ready now? Is there something that we need to wait 6 months to get investment funds? What is your criteria? Are you looking for specific markets? And then we put the plan together. We get a plan nailed down. We identify where the markets are that you're looking to invest and why. And the most importantly, we introduce you to all the key players we have in our team. We have everybody under one umbrella to help you blend the team together for a successful real estate transaction. It's a great program and great process for your self-directed 401k, also 1031 exchanges. And of course, the best part about it is we can also offer real estate with 401k and IRA checkbook. I want to introduce you to our speaker tonight. His name is Dmitry Fomichenko, and he's the founder and president of Sense Financial Services. It's a boutique financial firm specializing in self-directed retirement accounts with checkbook control. He began his career in financial planning and real estate investing in 2000, right when I did. He owns multiple investment properties in various states and is a licensed California real estate broker. Over the years, he taught hundreds of investment and financial planning seminars and has mentored thousands of investors. He's going to be a wealth of knowledge for you here tonight, and I'm proud to turn the mic over to him right now. Here's Dmitry.
Thank you, Sherry, so much. Can you hear me okay?
Yes, we certainly can.
Okay, well, thank you for having me, and I'm excited to present tonight and on the topic of the using your IRA and 401k to invest in real estate. Quick disclaimer, my specialty is retirement accounts, self-directed retirement accounts, and specifically those that offer checkbook control capability. I'm not a tax professional, I'm not a legal advisor, and I don't offer this kind of service. So keep that in mind. I'm gonna share some information, but if you need a legal or tax advice, be sure to talk to your to a qualified professional. And so quickly, our mission statement is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we want to come along your side and we want to help you because we know that you work hard for your money and we want to help you make sure that your money works hard for you. So how do we do that? We utilize self-directed retirement accounts with checkbook control. And to illustrate what we can do for you, I wanted to show you an example. Jason is one of our earlier clients, and we did this IRA makeover for him. He had 2 retirement accounts before he came to Sense Financial, valued at about $135,000. Now, remember, this example is about 10 years ago, maybe 11 years ago. He was losing money in the stock market, just like probably some of you looking at your statements and watching your account balances being depleted. So he searched online, he found us, he contacted us. I remember doing a consultation with him, and we established a self-directed solo 401k for Jason, giving him the ability to have checkbook control over his retirement funds and ability to invest in alternative assets. So what he did with his money that he rolled over is he purchased a rental property, he invested in his brother's business, and he used the remaining portion as a note or investing in a note, basically using his 401k as a bank. Instantly, he started cash flowing about $1,000 a month. So from day one, from losing money to starting cash flow immediately. This is a stable, predictable cash flow, and the value of his portfolio started increasing. And right now it's probably tripled in value, and his income more than doubled. So this is just one example of what we do for our clients. Quick comparison of the conventional retirement account. If you, just like many other people, if you have a retirement account with your employer, such as 401k or 403b, or individual retirement account, an IRA, it is controlled by the custodian who allows you to invest in the stocks, bonds, and mutual funds. So the investments are confined by the stock market. Now, self-directed, on the other hand, do not have those restrictions. With self-directed retirement account, you're able to invest in alternative assets such as real estate, tax liens, tax deeds, options, mortgage notes, trust deeds, business and partnerships, international real estate. We do have clients who invested in Canada, Mexico, South America, in Japan, in Europe. So you have the ability to do so. And you can also, some people mistakenly think that self-directed IRA is like a real estate IRA. You're only limited to real estate. You're not limited to real estate. You can invest in virtually anything. There is going to be a couple of restrictions, a couple of limitations. I will share that with you in the coming slide, but you can invest in virtually anything. So what are the options? And those options are self-directed IRA that is held by the custodian, Checkbook IRA, also known as a IRA LLC, or IRA Trust. We recently started offering IRA Trust specifically for our California clients because of the cost of maintaining IRA LLC. So IRA Trust is a great alternative, but works just the same way. And third option is a self-directed solo 401k plan, which is also known as the ultimate retirement plan. And you will see why that nickname. You'll see after you see the benefits that it offers. So let's take a look at the first option. What is a self-directed IRA? It is a tax-deferred trust account that is held with the IRS-approved custodian. It allows you to invest in non-traditional assets. It's been placed in use back in 1974. It's been created by the federal law, and it's still very little known. Although many people use that, there is more people that not aware of this option. And the reason people don't know, because your stockbroker and financial advisor, they don't want you to know about this, because they want you to keep invested in with conventional retirement accounts and stocks and mutual funds, because that's how they make money off of your retirement account, regardless whether you make money or not. But the truth is, you and I, we have no control over the stock market, and with alternative investments, there is a much better degree of control. But this account's been created to benefit people like yourself, to save money for the retirement under Internal Revenue Code Section 408. So let's take a look how it works. The benefits of the self-directed IRA is that allows you to invest in non-traditional assets, meaning that you have the ability to truly diversify your investments. Because if you're just invested in a mutual fund, for example, then you might think that you're diversified because your investment is split in 100 different stocks, but it's still in one asset class. You don't have a true diversification. That you can only accomplish with a self-directed IRA. The returns that you generate from your investments are sheltered from taxes, so you're able to grow your account much faster. There is no capital gains on the sale of the real estate. You can buy real estate within your IRA, you can sell it a few years later, all the gains will be protected from taxation. And you can even use leverage. So you can buy more real estate by using leverage, but you have to use a non-recourse financing with that. And I do have a slide on this coming up. So how does it work? Step number one, you open a new account with the IRS-approved custodian. You have to have a custodian that allows alternative investments. Step number two, you perform a transfer. It's a qualified transfer where you move directly from one custodian to another custodian. In this case, there is no tax consequences, there is no penalties because you're not touching the funds. Then you, as the account owner, you direct the custodian. Remember, custodian holds the assets, holds your account, but you tell the custodian what to do. And you can tell them you want to buy a piece of real estate, or you want to invest in this note or a mortgage. all the income from the investments going back to the IRA, all of the expenses being paid from the IRA. But because you don't have access to the IRA directly, you have to go through the custodian. Each time you do a transaction or you make an investment or sell investment, there are fees. So custodians are in business to make money, and those fees do accumulate. Many investors don't like this idea because of the fees, but also secondarily because of the lack of the control. So they opt for the Checkbook IRA, which I'll explain in a moment. But the benefit of the self-directed IRA, it does allow you to have diversification. But the disadvantages are delays, lack of direct control. You have to deal with the red tape of the custodian. You have to value asset each year to provide the custodian, and the fees for issuing a check, for buying and selling investment, transaction fees, and asset-based fees. The solution to that is a Checkbook IRA. Checkbook IRA, also known as a IRA-owned LLC or IRA-owned trust. That is a special purpose single member LLC or a trust that is created with the purpose to be owned by the IRA. So there is no, you're personally not involved, your personal finance is not involved in that. It does require IRS compliant operating agreement and set up. Once the structure is set up, it allows you to bypass the custodian when making the investments and transactions. So you'll see that on the next slide. The step number one, the same way you will have to open a new account with the IRS approved custodian that allows LLC or a trust to be set up inside of your IRA. Step number two, you do a qualified transfer. You move funds directly from your existing retirement account to the new self-directed IRA. Step number three, that is where the special purpose single member LLC is formed, or again, especially for our California clients, we utilize a trust to avoid the $800 franchise tax. Once that LLC is established or trust is created, then you become the manager of the LLC or you become the trustee of the trust. And you will then instruct the custodian to buy 100 units of the LLC. The business checking account will be opened for the LLC or for a trust at that point, and you as the manager of the LLC or trustee of the trust become the signor on that bank account. So funds are transferred from the IRA into the bank account, and from there you're now able to start making investments. And you no longer have to go through the custodian for those transactions. You no longer have to submit any requests. The investment transaction can be done as quickly and as simply as writing a check or sending a wire from the business checking account. Similarly, all the income must go back to the LLC or trust business checking account, and all of the expenses are being paid from that bank account. But there is no transaction fees because you're not using a custodian any longer. You actually making transaction yourself by writing a check because you are in control of that checking account. So the advantages of Checkbook IRA, it allows you to bypass the custodian. You have direct access to your funds without a middleman. You're able to execute transactions quickly without delays. With the LLC, you get additional protection from litigation. The cost to maintain this is low because there is no transaction fees. You just pay a fixed annual fee to maintain that custodial IRA account. And the assets title held in the name of the LLC or in the name of the trust, respectively. The third option is a self-directed solo 401K. Let's talk about that. It is a retirement plan that is created under Internal Revenue Code Section 401, subsection K. So that's where the name comes from. It is designed for those people who are self-employed or own a small business. It is not a new type of plan. It's been in existence, but it's just essentially a traditional 401k plan that just covers the owner and the spouse of the owner. This type of plan was made possible as a result of changes in the tax law back in 2002. So they've been around for over 20 years now. The law changes made many current benefits of the solo 401k possible. So we'll take a look at them. But before the benefits, let's talk about eligibility. Solo 401k plan is not for everyone. It's designed for those people who are either self-employed or own a business. So two requirements you have to meet. Number one, you have to have a presence of legitimate self-employment activity that generates earned income. The activity can be in any form. So if you receive income that you report on Schedule C, or if you own a company such as LLC or a corporation that generates income, then you meet that criteria. And number two, absence of full-time employees. You can have part-time employees working under 500 hours a year, but if you do have full-time employees, then you will be required to offer them 401k benefits as well, and a solo 401k plan will not work for you then. You need to have a full-blown 401k that can accommodate employees. The absence of full-time employees, to further clarify that, you can exclude leased employees. You can exclude employees that are under 21 years of age and those that work less than 500 hours annually. So let's take a look how it works. Step number one, you have to have the plan sponsor in place. Plan sponsor can be a business that you own, a corporation, LLC, or a partnership, or if you are like many of my clients who are real estate agents, they simply do business under their own name. They don't have an entity, that is fine as well. You can do that. That makes you a sole proprietor. So sole proprietor is legitimate business type that qualifies you to establish a solo 401k plan. Then step number two, plan sponsor adopts the plan, and we create a plan and trust. With the solo 401k, we utilize a trust structure which enables you to or used as a holding entity for your plan assets, because with an IRA you have a custodian holds the assets. With the 401k there is no custodian, but you cannot keep your plan assets in your under your pillow, so you have to have it somewhere, and that somewhere is a trust. Trust is a separate legal entity that holds the plan assets. You become designated trustee of the solo 401k trust, and you control the trust. So you decide how you want to invest, and again, the investment can be made as simple and as quickly as writing a check. As a trustee of the 401k trust, you will open a business checking account at a bank or a brokerage in the name of the 401k trust using its own tax ID number, and then all of the income from the investments will be flowing back to that bank account, and all of the expenses will be paid from that business checking account. There is no middleman, so there is no transaction fees, there is no asset-based fees, and you are in full control. Now let's talk about the benefits of the solo 401k. Probably one of the main benefits is the ability to make large contributions. With the solo 401k, because you're wearing two hats. You're wearing a hat of an employee. You, let's say, as a real estate agent, you're doing the work, you meeting with the prospective buyers and sellers, you helping them, but you also own a business, so you're wearing a hat of an employer, and you can contribute as both. That's why the limit is so high. I'll break that down for you on the next slide. Proverbs 21:20 says that the wise man saves for the future, but the foolish man spends whatever he gets. So if you're self-employed or in a business for yourself, or even if you're employed, it's a wise thing to do to set some money aside for the future. So let's take a look at the details of the contribution limits. As I said earlier, there are two components. So as you can contribute as an employee and also as a business owner, as the employer. As an employee, you can contribute up to $22,500. If you're over 50, then there is additional $7,500 in the catch-up. That makes it $30,000, and that can be up to 100% of your compensation. Let's say you're actually employed somewhere, but you also have a side business, and you generate $30,000. Well, all of that potentially can be contributed to a solo 401k. Now, with the solo 401k, this amount, the employee component, you can also contribute either pre-tax or after-tax into Roth. So, and that is not dependent on the income. Now, as the business owner, you can contribute profit-sharing contributions. The profit-sharing contributions can be made up to 25% of your compensation. If you're sole proprietor, it's 20%. If you're incorporated, it's 25%. The combined limit of the two is $66,000 per year for 2023. And if you're over age of 50, then that limit raised up to $73,500. That's huge. I mean, think about this. If you're in a business for yourself and you're doing well, you can shelter $70,000 of your income from taxes. Now, what if you're in business with your spouse? Together, you can shelter potentially almost $150,000 of your income from taxes. Think what it's going to do to your bottom line as far as the taxes are concerned. You're going to be able to drop your income significantly, which will result in being dropped to the lower tax bracket. So you're going to be paying a significantly lower amount in a lower tax bracket. So if you were to maximize that, you potentially can save $30,000, $40,000, $50,000 in taxes in a single year. It's mind-blowing, but that's true. You can certainly do that. You also can take a participant loan from your 401k. That's not possible with an IRA, but from the 401k, you can take a loan. The loan is amortized over 5 years. It has to be repaid either monthly or quarterly. The interest rate for the loan is set at prime plus 1%. You can use it for any purpose, and it allows you to access up to $50,000 or 50% of your account balance, whichever is less, at any time for any reason, without any tax consequences or penalties. Again, not possible with an IRA. You don't want to abuse the loan. It's there. It doesn't mean you have to take it. Your primary goal should be investing your 401k funds so that it can grow tax deferred or tax free with the Roth, not borrowing from it. But if there is a need, you can potentially take the loan. So essentially what you're doing is you're creating your own bank that will never turn you down, because you're the one applying for a loan and you're the one approving that loan. Next, you have the ability to make Roth contributions. Every solo 401k plan that we establish comes with the Roth provision. That means that you can contribute after tax. There is no income restriction for this type of contribution. Now, if you compare that with the Roth IRA, if your income is over a certain threshold, you're not eligible to contribute. The limit for the Roth contribution is $22,500 plus the catch-up. So compare that with $6,500 plus $1,000 catch-up with the Roth IRA. So again, it's significantly higher and it's not subject to the income restriction. All of the income and gains that are generated inside of a Roth account will be tax-free because qualified distributions are tax-free. You can actually access your contributions at any time because you already paid taxes on those. And if you have pre-tax money, you can actually perform a Roth conversion. The provision of the Roth allows you to take your pre-tax money and convert that to Roth, which will be a taxable event, but then you're going to be able to invest tax-free for the rest of your life. Next, it's very cost-effective because there is no custodian. All the custodian fees are eliminated. Red tape and delays are eliminated. You have the checkbook control because as a trustee, you have a checking account that you control. You can act quickly. They're easy to operate. There is very simple requirements. If you are under $250,000, no filing requirements at all. If you reach that threshold, then you will have to file a short form 5500 EZ. So the bottom line that allows you to achieve true diversification. And to make a point, I'm going to use this cartoon. The credit goes to my daughter, who says the man holds the basket and says, or the basket represents the stock market, bottom fell off, all the eggs are gone. But and wife says, I thought that our investments were diversified. Well, guess what? If you are in just a single asset class, it's possible for the bottom to fall off that particular asset class, and you're going to end up with broken eggs. But if you're diversified in different asset classes, if you have some money in the stock market and then you have some money in real estate, you have some money in perhaps precious metals, and you do some private lending or invest in a business, then you have different asset classes. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. So it's very wise principle to follow when you're investing, because again, we don't know what's going to happen tomorrow. And by diversifying, that enables you to minimize the risk. Unlimited investment options means you can invest in real estate, residential, commercial. You can invest in tax liens. You can invest in trust deeds. You can buy precious metals. You can invest in cryptocurrency. And you can use your 401k money as a bank and bid a loan. I personally used Marsh Reddick lending program, and I've done probably a couple dozen loans. I also invested in a fund. So that's the example of using your IRA as a bank and investing in mortgage notes or a fund, which is a collection of mortgage notes. Now, we talked about many options that are available for you, but there are some limitations. So let's take a look at those limitations. They are described in the Internal Revenue Code section 4975 and the Prohibited Transaction Rules. And I just want to pause and let you guys know that there's a lot of information that I'm going through, and I'm speeding through this because of the limited time tonight. But if you do have questions, type them there in the in the chat or a Q&A session there. We'll do the Q&A session at the end, and we'll try to get to as many questions as you have today. If not, I'll get back to you tomorrow. But so use that chat button to type your questions. So back to the prohibited transaction rules. These rules specify what you cannot invest in. And you cannot invest in collectibles, you cannot invest in life insurance contracts, and you cannot invest in an S corporation. Now, many people misunderstand this and say, if you do have a S corporation and you have no employees, you certainly can establish a solo 401k plan. You're just not able to invest your 401k or IRA money into another S corporation. So that's what it means. The same rules describe disqualified person, and a disqualified person is basically yourself, your spouse, and your immediate family members. Entities that are controlled by those persons the exception to that is extended family members, such as brother, sister, cousin, uncle, aunt, and so on. So if you are, the IRS rules prohibit retirement plan to engage in any transaction with disqualified person. And I'll give you some examples here. The section 4975 defines the prohibited transaction, and that is a sale, exchange, or leasing of a property between a plan and a disqualified person. Lending of money or extending a credit between a plan and disqualified person. Providing goods or services or facilities between a plan and a disqualified person. Transfer to or used by for the benefit of a disqualified person of the income or assets of the plan. Any act by a disqualified person where he deals with the income or assets for his own benefits can do that. And also receiving any consideration for his own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with a transaction involving the income or assets of the plan. So let's take a look at some examples. Engaging in a transaction directly or indirectly with a disqualified person. So example to that is you own a property and you ask me a question, can I transfer this property to my 401k? And the answer is no, because you are a disqualified person. You're not allowed to sell the property or otherwise engage in a transaction with disqualified person. So that will be not allowed. So buying a property from a disqualified person is a no-no. You can't use your IRA as a security for a loan or guarantee the loan to your IRA or 401k, because you're a disqualified person. You're not allowed to guarantee the loan. The loan has to be non-recourse. Any investment in a business in which plan participant or any other disqualified person already has 50% or more ownership, that will not be allowed. And another example, if you're a real estate agent and you want to buy an investment property for your self-directed solo 401k plan, you are not allowed to represent a 401k because you will be breaking two rules. Number one, you will be providing services to the plan as a real estate agent. And number two, you will be receiving a compensation as a result of this transaction. It's not directly from an IRA, but it's a transaction that your IRA is involved in. So you will be indirectly breaking a second rule as well by receiving a compensation. So that such transaction will not be allowed. And any commingling of funds between an IRA and a plan participant's personal account. You must remember that your IRA and 401k funds cannot be commingled with the personal or your business finances. Everything has to be kept separately. Quickly on buying real estate with your retirement account, certainly possible. It's very common. I own real estate personally in my retirement account. All the income and gains generated by the account are tax deferred. You pay taxes at the future date rather than in the year when the investment produces income. All the income and gains inside of a Roth are tax-free. And you must remember that all income must go back to the account and all of the expenses must be paid from the account. You personally cannot pay for the any expenses, let's say a repair on a property that your IRA owns. IRA must pay for that repair because IRA owns the property. You can also finance real estate, as I mentioned, but you cannot provide a personal guarantee. Therefore, the loan must be non-recourse. And Marsh Reddick offers such non-recourse loans to retirement accounts. Property in this case serves as the only security for the loan. That's what it means, non-recourse. There is no personal recourse for you. Typically, you need to come up with 30 to 50% down depending on the property type and location. The property must cash flow to satisfy the mortgage and all the expenses. You also have to have reserves. Lender will require to have the reserves. It will trigger UDFI tax, which is stands for Unrelated Debt Finance Income Tax in an IRA. But 401k is exempt from this, so you can buy real estate inside of an IRA and be taxed on portion of that income, but you can do the same thing with the 401k and no tax consequences. Like I said, there's only select number of lenders that offer this. Marsh Reddick is one of them, and you can find the full list at this list, the link below. We do have that list on our website. There's about a dozen of lenders that do that. A quick comparison between the different types of accounts. Again, guys, if you have any questions, type your question in the chat and we'll get to that. So all of the accounts, they do allow non-traditional investments, but custodian is required. With an IRA, you must have a custodian. With the 401k, there is no need for a custodian. So solo 401k does not have a custodian. It's simplified structure and more cost effective. You do have the checkbook control with the IRA LLC or IRA trust and the solo 401k. The self-directed custodial IRA does not give you the ability to have the checkbook control. You have to go through the custodian for each transaction. The opposite transaction fees are with the custodial IRA and the checkbook IRA. There is no transaction fees. If you go with the IRA LLC, there are LLC fees, such as California charges $800 franchise tax. For that reason, the alternative is to use an IRA trust, which allows you to eliminate the LLC franchise tax fees. There is no additional fees for maintaining that account except a nominal fee to maintain your IRA. You can take a loan from the 401k only. You're not allowed to take a loan from an IRA, so that's not an option. There is UBIT tax on leveraged real estate inside of an IRA. 401k will be exempt from that. You can contribute up to $73,000 with a solo 401k, and with an IRA 7,500. So solo 401k is a great tax shelter. If you're eligible, it's a must. Everyone will benefit from that as a self-employed. Also, solo 401k gives you the ability to have a built-in Roth component within the same plan, but solo 401k is not for everyone. You must be self-employed to qualify or own a business. We've gone through this and we'll try to get to some of the questions here, but I would like to offer a special offer to you guys, all who attended tonight or watching a recording of this. You can request complimentary consultation with me. Just go to sensefinancial.com/consultation, and that will take you directly to my calendar, and you can see my availability in real time, and you can book a slot and we can chat specifically about your particulars and just brainstorm. We may or may not be able to help you, but I'm offering this to everyone on the call today, on the webinar. Also, in addition to that, all the attendees will receive an offer of $200 discount on our services, regardless which service you're going to pick. That's our way to say thank you for Marsh Reddick members. And that will be my part. Sherry, I'm going to bring you back. I believe you also have a couple more slides to wrap this up, but this is our contact information. Feel free to reach out to our office. You can schedule consultation over the phone. You can email us, or again, book that consultation online.
Thank you so much, Dimitri. This has been valuable information. You don't understand how very positive and how great a proposition it would be to have a solo or checkbook 401 IRA. We have them ourselves, my husband and myself, and I want to thank Dimitri again for being with us tonight. That was a wonderful presentation. There was one thing we actually really pride ourselves on here at Marshall Reddick, and it is education, much like tonight's presentation. But we also have a website full of information on anything and everything you can imagine in relation to real estate and real estate investing. And we have a variety of ways to get you your information: articles, data packages, taped webinars, videos. Much like tonight's presentation, we have them in storage on our website for you to access at will. And it's free to become a member of the Marshall Reddick family. All you have to do is sign up, and the education is all there for you, free and online at your fingertips. And if I were to suggest one thing to start with, is to download immediately, would be our property rating ebook. It's about a 20-minute read, and it's valuable information no matter where you are in your real estate investing journey. It really is the primer to how to become a successful real estate investor. You can access it at our website, marshallreddick.com/ebook. Sign up for a free account at that same time, or you can always text or email me, and I can send a copy over to you. But I strongly suggest you start with that, and then once you start with that, you will have so much valuable information at your fingertips going forward. This is my contact information. You might want to just take a screenshot of it so you have my contact number. If you need a recording of tonight's presentation, if you have a problem getting the ebook or you want me to help you with it or schedule a complimentary consultation, please don't hesitate, reach out. You've got my phone number and you've got my direct email address. I'd love to chat with you. And if there's no questions, it doesn't look like we have questions in the queue. I would like to thank each and every one of you for joining us tonight, and I hope you found this presentation valuable. Have a wonderful evening, everyone.
Thank you so much for joining. Good night.
Good night.